What's up, everyone? It's Cowdy with Money Vesting, and man, oh man, there's been so much chaos in the last 48 to 72 hours, considering that Silicon Valley Bank has pretty much collapsed. Got some new updates, so I'll be talking a little bit about. So again, I've put out a couple videos already on this issue and talking a little bit more about what the reality of the situation is. Why did Silicon Valley Bank go down? How it's affecting three parties, so customers, investors, and other regional banks. And in this video, we're going to talk a little bit more about the future and what the solution could be, or where, how the situation is all going to play out. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, trade alerts, all that stuff. The link's going to be down below if you're interested in joining. Now, there's one organization that obviously can come to the rescue, but even they don't have enough capital, and that is going to be FDIC. So we've got, the Federal Deposit Insurance Corporation, which you may or may not have already heard of. It is a government organization which pretty much insures depositors' cash in a bank, but up to a certain limit, right? So up to $250,000. And you may have seen, like, when you are first starting out an account with a bank account or whatever it is, you may have seen it in other documents, FDIC insured, or FDIC insurance up to $250,000. You may have seen somewhere something like that, and that's exactly what it is, right? You never kind of have to go over it because it's never really a very common occurrence. You're like, hey, FDIC insurance, $250,000, whatever. Like, I don't care. And now it becomes more of a bigger problem. And now everyone obviously needs to understand how FDIC works. And then what is going to be the actual numbers that we're working with when it comes to the Silicon Valley Bank going down, and with respect to how much in cash and deposits they already are insuring at the moment. So when it comes to FDIC, the number of insured banks has been going down. So it's now sitting at 4,706. So 4,706 insured institutions filed call reports in the fourth quarter 2022, a decline of 40 institutions from the third quarter 2022. So these are how many insured banks FDIC has. Now, when it comes to DIF balance, which is a deposit insurance fund, balance was $128.2 billion on December 31st, 2022, up from $2.8 billion, up $2.8 billion from the end of last quarter. So slight increase there. But this is how much in deposit insurance funds FDIC has. Now, as we already know, that Silicon Valley Bank was the 16th largest bank in the US, according to my estimates here. And at the same time, it was the second largest bank failure. We are working with some large numbers, right? We are working with companies and customers that had tens, hundreds, millions of dollars in that bank here. And this right here is the unfortunate part, which is the DIF reserve ratio, which is the deposit insurance fund reserve ratio. In other words, goes over what percentage of reserves FDIC has with respect to the total deposits in the US banking system. And that is less than 2%. Less than, in fact, 1.5%. So the amount of DIF relative to the insured deposits rose on 1 basis point to 1.27% for the quarter. So that is how much in reserve ratio, in other words, the reserves they have, insurance funds they have against the depositors' money. That's in the U.S. banking system. So really, really low. I mean, if tomorrow we were in a really bad situation where, let's say, there was bank runs all over the country, where we had in the U.S. pretty much all banks, doesn't matter what it is, regional banks, small banks, large banks. If there was bank runs everywhere, FDIC unfortunately would not be able to pretty much insure everyone. I mean, they don't even have enough funds available to insure every bank out there. So the thesis, or the main premise, is that there is going to be a treasury bailout, or a government bailout, and at the same time, not all banks are going to collapse at the same time. Of course, that's why you see that little dip there, right? And then you go back, you see a little dip over here back in 07, 08, when these reserve balances pretty much went in negative and dropped so heavily, and since then they've been growing. That's the great financial crisis. That's a great recession where Lehman Brothers collapsed, a lot of other banks collapsed and kind of merged together so that their resources were coupled and they were kind of still afloat, and took the loan or took the bailout from the US government as well. So number of problem banks has been decreasing, so that's good. The number of banks on FDIC's problem bank list declined to 39 during the quarter in the fourth quarter, and there were a few tweets that I also wanted to go over. The first one is from Bill Ackman, which is actually pretty long. It is really, really long if you think about it, so I'll read certain parts of it, but he pretty much says the government has about 48 hours to fix a soon-to-be irreversible mistake by allowing Silicon Valley to fail without protecting all depositors, and the world has woken up to what an uninsured deposit is, an unsecured illiquid claim on a failed bank. And that unfortunately is true, and you know, they kind of missed on banking 101, the main part, Silicon Valley Bank, because they borrowed short term and they invested long term, right? When you borrow short term, which is depositors' money, you always buy short term, and that's US Treasuries. But the problem is the treasuries back then, 3 years ago, weren't paying you anything, and they were in search for yield, and their loan book didn't grow as fast enough, so they had to overreach, and go after mortgage-backed securities, and as a result, we're in this mess. And he goes on by further saying that absent JP Morgan, Citi, or Bank of America acquiring Silicon Valley Bank, before open on Monday, a prospect I believe to be unlikely, or the government guaranteeing all of Silicon Valley Bank's deposits. The giant second sound you will hear will be the withdrawal of substantially all uninsured deposits from all but the systemically important banks, SIBs. These funds will be transferred to the SIBs, U.S. Treasuries, money market funds, and short-term U.S. Treasuries. There's already pressure to transfer cash to short-term U.S. Treasuries as U.S. Treasury money market accounts due to the substantially higher yields available on the risk-free U.S. Treasury versus bank deposits. So what he's really saying over here is that there's already pressure from higher yields for this flight to quality. Remember we talked about this? I mentioned this 3 to 4 days ago, maybe even last week, where there is going to be a flight to quality with these higher yields because it's a no-brainer, right? It's a risk-free rate you're putting in with the U.S. Treasury. It's backed by the U.S. government, right? So you don't have any sort of risk related to, repayment. You're getting the coupons and you're getting the principal back at maturity. So it's a no-brainer for most companies to be stacking away cash in U.S. Treasuries. And now when you get this, it's going to really just put everybody on edge with this risk-free rate of U.S. Treasuries. Now, these withdrawals will drain liquidity from the system and regional and other banks and begin the destruction of these important institutions. The increased demand for short-term U.S. Treasuries will drive short rates lower, which is your 6-month, 1-year, and 2-year, complicating the Federal Reserve's efforts to raise rates to slow the economy. Already, thousands of the fastest-growing, most innovative venture-backed companies in the U.S. will begin to fail to make payroll next week, and that's really true. That's a very, very unfortunate part. And had the government stepped in on Friday to guarantee Silicon Valley Bank's deposits in exchange for penny warrants, which would have wiped out the substantial majority of its equity value, this could have been avoided, and SVB's 40-year franchise value could have been preserved and transferred to a new owner in exchange for equity injection. So we're not going to read all of it, but the bottom line is that this is pretty much a mess. The FDIC's and OCC's failure to do their jobs should not be allowed to cause the destruction of thousands of our nation's highest potential and highest growth businesses, and the resulting losses of tens or thousands of jobs for some of our most talented younger generation, while also permanently impairing our community and regional banks' access to low-cost deposits. So now this is where we are, and they also mentioned that SVB should have been high on their watch list with more than $200 billion of assets and $170 billion deposits from business borrowers in effectively the same industry. And then finally, so even without assigning any franchise value to SVB, the cost of government guarantee, unintended consequences of the government's failure to guarantee SVB deposits are vast and profound and need to be considered and addressed before Monday. Otherwise, watch out below. And he goes on by further also saying, so there was another tweet from him 6 hours ago. He mentioned that SVB financial depositors will get 50% on Monday, Tuesday, and the balance based on realized value over the next 3 to 6 months. And if this proves to be true, I expect there will be bank runs beginning Monday a.m. at a large number of non-SIB banks. No company will take even a tiny chance of losing $1 of deposits, as there is no reward for this risk. And absent a system-wide FDIC government deposit guarantee, more bank runs begin Monday a.m. is what he mentioned. So tomorrow, there is potentially, Monday morning, there's a possibility that we do start to see a bit of a bank run type situation. Now, this is going to be bank failures in brief, summary 2001 through 2023. How many banks have failed? According to FDIC's estimates, there's been 562 bank failures between 2001 and 2003. And you can see that in 2020, we pretty much had about 4 banks. And then over here, you'll notice that 2019, 4 banks. It was pretty, normally low. 8, 0, 4, 4, 0, 0, 2023, 1. But of course, this report is not completely up to date. And if you take a look at what happened in 2009, so if you come over to 2009, 140 banks, and 2010, 157 bank failures. And total assets, they were at 170 billion, and 2010, 96 billion. If that's from all the companies, all banks put together. And right now, we're working with, a little over $209 billion in assets at the time of failure for this bank. So obviously, this is a pretty substantial problem, and you can already start to see that green line spike pretty highly. And 2008 was the peak at $373 billion among 25 banks there. And right now, obviously, we're seeing a pretty substantial number there for bank failures. Andrew Yang also mentioned that I think either California or the Treasury Department should backstop Silicon Valley Bank. Thousands of companies will fold or lay people off next week because of lack of access to accounts through no fault of their own. And there's a big difference between irresponsible bank managers and the thousands of customers and entrepreneurs and employees who chose to use the bank that was one of the biggest banks in the country and the standard in the industry. Punish one, but the other are blameless except they didn't choose the right bank. And that's really where we are in this situation. Unfortunately, we are working with, very, very uncertain environment. And what this is going to do, in my opinion, is really there's going to be somebody who steps in, whether FDIC, of course, whether the US government, but there is going to be an external entity that kind of comes in and ensures some or all of their deposits. Obviously, it also depends on how much money is on hand. But Silicon Valley Bank definitely, dropped the ball on this one. And if there is a flight to quality, right, away from, traditional banks, regional banks, and deposits, and moves towards U.S. Treasuries, guess what that's going to do? That's going to drop the yields as expected by Bill Ackman. Of course, that's pretty logical because as the demand comes in, prices are going to start moving up. Yields are going to start moving down because of that inverse correlation. And well, next thing you know, it's going to be pretty disinflationary once again as yields come down and cost of borrowing starts to go down as well. So that is, again, a little bit of an update on what is going on with this entire debacle. Let me know your thoughts down in the comment section below. What are your